Hey everyone, Fiverr reported a quarterly earnings update that sent the stock price up by nearly 10%. But despite that jump in stock price for Fiverr, it's still down over 93% off its high. So I'm going to review the company's latest investor update and describe why I think Fiverr stock is a screaming buy at current valuations. So let's take a look here. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so like I highlighted, Fiverr stock is down over 93% off its high. And I've had Fiverr stock rated as one of my top stocks to buy in 2024. You can see I have it as a top 10 growth stock and a top 25 stock to buy in 2024. And I last updated this recommendation on April 30th. I'm reiterating this recommendation here today following the company's earnings results, which I have already reviewed myself. And in reviewing those results, I've reiterated my buy recommendation for Fiverr stock. So let's take a look at the key details from Fiverr's latest quarterly earnings update. Now, for the first quarter, the year started off better than expectations. And remember, coming into the year, I suggested that Fiverr's revenue forecast for 2024 seems to be a conservative forecast, and that's what management told us. And I said I wouldn't be surprised if they upgrade their full year expectations, and they've done that here. The first quarter was better than expected, and they have upgraded their annual target for 2024. Now, gross merchandise volume on the platform accelerated. It increased the rate of growth increase, led by a increase in business solutions. And that's why I like this platform business model that Fiverr operates, bringing buyers and sellers of services together. It's an asset-light business model, and that leaves cash to return to shareholders. Fiverr not being a difference maker here. And it announced an authorization of a share repurchase up to $100 million. So it's buying back its shares because the company is generating strong cash flow from operations. It doesn't need to reinvest all that much into the business, and so it can return that money to shareholders. What a breath of fresh air this is for investors, to have a company giving money back to investors. This is so much different than so many of those electric vehicle companies that I follow that are constantly going back to investors and asking for more money and saying, look, we lost so much, we need more. We lost even more, now we need more. Please give us more money. Oh, we lost this much more, we need more. Always going back to investors for more money. And I've highlighted that vehicle companies, especially electric vehicle companies, are very capital intensive. They're always needing money, and that's not good news for investors. This is the opposite of that. This is an asset-light business model, and this is what you see from these types of businesses. They keep giving money back to shareholders, which is what we want as investors, right? We want to put money in just one time, and then after putting money in one time, we want to just keep getting money back from our investment. And that's what we get with these types of businesses. So Fiverr saying that they're on track to deliver the 2024 guidance, and they're raising the low end of their guidance for both revenue and adjusted EBITDA. So they're upgrading revenue and profit forecast for 2024. Excellent news. It wasn't all great news for Fiverr. Active buyers again decreased by 6% year over year for two primary reasons. Number one, Fiverr is focusing more on high-value customers, and so their marketing is focused more on high-value customers. They're not just going after every customer anymore. And then number two, they've significantly increased the take rate. You can see that's up to now 32.3%, which is up by 190 basis points year over year. I highlighted that Fiverr just brings together two sides of an equation, those that want to buy services and those that are selling services. And Fiverr takes a whopping 32% of every transaction on the platform. That's the highest that I've seen on any of these platform companies that I follow. And I must be following roughly a dozen of these, at least a dozen of these types of platform companies. 32% is the highest I've seen. And so it's understandable that when you're charging that much, that you're going to lose some customers. And Fiverr continues choosing to increase this take rate and generate more profit per customer, per transaction, rather than lower this rate and keep more buyers and keep more transactions. So they're focused on monetizing rather than just growing the number of people on the platform. Now, you can see that result in a higher spend per buyer because they're focused on higher spending buyers. That was up 8% year over year. Solid again. So for the full year 2024 forecast, Fiverr is now forecasting 5 to 7% year over year growth, but it increased the bottom end of this guidance from 379 to 387 million. It upgraded it to 381 to 387 million. Adjusted EBITDA was previously forecasted at 65 to 73 million. It's now forecast at 67 to 73 million, which is a solid adjusted EBITDA margin. If you take this number, if they hit this target, if you take the adjusted EBITDA number and divide it with the revenue number, you get a solid profit percentage. And they've already demonstrated that so far year to date and so far for the business. They also highlight that the underlying business GMV grew by 2% year over year for the trailing 12 months. That's up from just 1% in the previous quarter. So doubling, accelerating the gross merchandise value on the platform. That's the total market value that Fiverr takes its percentage fee from. So as that grows, Fiverr can take more of its fee, its take rate from that total value. And one of the bigger risks for Fiverr, and one of the reasons why the stock price is down more than 90% off the high, is because investors were concerned that artificial intelligence is going to be a killer for Fiverr's business. And all along this time, I've said that I don't think that to be the case. Now, I follow several companies that I've said AI is going to kill this business, one of which is Chegg, ticker symbol CHGG. I highlighted that's my top stock to avoid in 2024. It's already down significantly because of AI. AI is really hurting that business, and I identified that. But with Fiverr, I don't quite see it as a business killer. I see it as a business changer. It's going to change the type of services that people go on to Fiverr to purchase. And that's what management is saying, that they continue to see AI as a net positive impact for us. They've talked about this several times, how they're seeing the jobs changing from a certain type of job that people were going out to look for. Now they're looking for different types of job. For instance, they're seeing significant demand for chatbot development. And so that's an AI job that people are going to Fiverr for. So I agree with that. I think it's going to be hurting some jobs on the Fiverr platform while creating new jobs on the Fiverr platform, and overall it being a net positive for Fiverr in the long run. So Fiverr, even after rising following the earnings release, it's still trading at a relatively cheap valuation, a forward PE of 9.465. And so that's why I reiterated my buy recommendation for Fiverr stock, suggesting that I still think it's a top 10 growth stock and a top 25 stock to buy here in 2024. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.